Hey everyone, thank you for tuning in. Today is February where are we now? 25th? Yeah, Wednesday the 25th. And in this video, I want to briefly cover an SPX box spread. Okay, so let's construct one that's roughly a year out. Go through building it, and then I'll briefly discuss why you might want to do such a thing. Okay, so Feb 18th is roughly a year away, just a touch under a year by about a week. So let's see, yeah, 358 days. So 1 week less than a year. So I'm just going to use a simplification and we're going to call this a year, even though it's a little less. All right, so when you're buying a box spread, you can think of it a few ways. One way is you're buying a call and selling a put at, in this case, the 6,900 strike. So this would be synthetically, you are mimicking being long the SPY index, SPX index. And then I'm going to go 100 handles higher and I'm going to sell a call and I'm going to buy a put at the same strike. In this case, the 7,000 strike. All right. And this mimics selling it. So you're synthetically long the 69 line and synthetically short at the 7,000 line. And this box spread has to go out for the difference in the width. So in this case, the width between the 7,000 strike and 6,900 strike is 100. The multiplier on this contract is 100. So this is going to go out no matter where SPX closes in a year or at expiration, which is February 18th of 2027. This box spread is going to be worth $10,000, which is 100 times 100. Today's price, and again, I'm just going to simplify and use the mid price here. 96, let's just call it 15. So let's say you bought this box spread for 96.15. It's going to cost you, and you buy one lot. So it's going to cost you $9,615. And in a year, you're going to get 10,000. So one simple reason why you might want to do something like this is instead of going out and purchasing T-bills or putting your money in a money market fund, you can use the institutional funding rates via the option market to get yourself we're going to get 10,000 in a year, and we're paying 9,615 today. So that's $385. $385 divided by 96.15, which is what we put up. So you're getting a touch over 4%. We can just call it 4% as a simplification. Remember the duration of this contract is a week less than a year. And I'm not going to bother annualizing that last week. We'll just call it 4% as a simplification. So again, you're spending $9,615, and in a year, you're going to get your 10,000. And this is cash settled, so it'll be $10,000. And your earn on that is roughly 4% a year. So that's the return you will get for lending money out for a year. Now, if you're borrowing, you can do the same thing. If you sold this, okay, if you reversed everything here, and let's say this is going to be a sell, this is going to be a buy, this is going to be a buy, and this is going to be a sell, okay? And again, we'll do the mid price, so let's just go with 96.15 again, 96.15, 96.20. If you sold this box spread, you're going to receive $9,615, and in a year, you pay back the 10,000. So the interest on this loan, you can think of it as a synthetic loan, is 4%. And sometimes you can, well, I don't want to start to go down a rabbit hole. Okay, so let's just stick with the borrowing rate is 4%, and the lending rate is 4%. So this is one way to create a synthetic loan for yourself. You don't have to go out a year in time. If you were using a synthetic loan this way or creating a synthetic loan this way, you could structure it. So let's say, for example, you know that in 3 months you're going to need X, $10,000. Okay, so you just set these up so that every 3 months or 3 months from now, when you need the money, you're going to get the $10,000. Or if you want to borrow money for 3 months, same thing. You just create the synthetic loan, and in 3 months' time, you're going to pay back the amount that you borrowed. Okay, so that's a brief description of an SPX box spread. Something else you might want to do with this. Let's say you have $1 million or so in your portfolio, and you want to borrow 100,000. Well, here's 10. There's 10,000, and I wouldn't go ahead and set this up as a 10 lot for the 100,000. But let's say you wanted to borrow $100,000 and deploy that capital however you wish. So just in case something pops up, you want to put another $100,000 into the market. You know that at this point it will cost you roughly 4%, but in the meantime, let's say you don't know exactly what you will do with it, and you have your money just sitting in the brokerage firm, whichever firm you use, and they pay interest on your idle cash. Let's say that they're paying 3%. So you're borrowing at 4%. You're waiting to pull the trigger on whatever investment or speculative move you decide to deploy it into, borrowing at 4%. Your firm's giving you 3% on the cash. So your effective rate on that synthetic loan is 1%. And there are countless ways to get creative with this kind of thing. But what I wanted to do is just go over a brief example of what you can do with it, how to construct a loan, how the basic mechanics of it work. And that's basically it. That's an SPX box spread. Now, I wouldn't go ahead and do such a thing in options on stocks, because there can be problems with, for example, if you have a box spread in whatever, let's just call it X, and then some of the options in the position get exercised. That's where you can run into a bit of problem, or other weird things can happen that can end up costing you money. The nice thing about doing it here in the SPX is that this is cash settled. Unless you have some sort of margin call, you just sit and wait for this to expire and you collect your money. Or if you borrowed via the options market and got the institutional rate, you pay it back. And it's basically as simple as that. Okay, I hope that was helpful. That's going to be it for now. I will catch you guys next time.